Hi, Prabhu. It's Pranjul from Edelweiss. How are you?
Very good, Pranjul. Good to see you. How are you?
Good to see you as well. How's your weekend?
It was very good. Shelter in place, but as you can see, the beautiful area of Northern California makes up for it.
I'm extremely jealous. I'm in Long Island, and I can't say I have the same environment as you do. So it's very, very nice to see. Great. Well, thank you so much for speaking with me today. I'm sure our audience is very excited to learn more about your pension fund and yourself and your thoughts around this pandemic that we're going through right now and how to navigate through it and all that. So very excited to finally speak with you. So maybe we can just dive right into the pension fund. I know it's about $6.5 billion, but if you can kindly just break it down in terms of the asset classes, the percentages, and what are you seeing going forward, that'd be great for our audience.
Yeah, so we have two different plans that we manage in the pension office and the investment office. So we have the police and fire plan, which is the San Jose Police and Firefighters, which is about 3.5 billion, and another 2.5 billion for the rest of the city employees. So a total of a little over 6 billion, and we have two different boards that actually manage and oversee these plans. In terms of the breakdown, we are roughly about 70% or so in growth assets.
Okay.
And growth assets, again, comprise public and private equity, venture capital, private credit, a little bit of high yield and emerging debt. And another 30% is allocated between two other buckets that we call zero beta or low beta. And the other is another bucket where, we have some inflation protection assets and so on. So the zero beta or low beta is basically assets that it's sort of twofold. One is it's immunized cash flows, so we're able to meet our obligations over the next 5 years. We put that aside. And we also keep some dry powder. So whenever there's opportunities in the market, we're able to quickly move into those growth asset classes. So that's at a very high level, that's the breakdown of the assets.
Now, as you speak to GPs in general, what asset classes have you seen the largest or biggest decline because of this pandemic? And are you looking to add more capital to those asset
Yeah.
classes?
Firstly, let me say, the pandemic is a big tragedy, right?
Yeah.
On several accounts, it's a human tragedy. It's definitely a medical problem as well as an economic problem. And our hearts go out to all those who've suffered because of the pandemic. But as you know, in markets, disruptions cause opportunities, right?
Right.
And so in March, we saw one of the biggest drawdowns in recent times. And if you take the S&P 500 as a proxy for the market, the S&P 500 was down about 35% peak to trough. And in the last 100 years, Pranjul, if you see, we've had 12 bear markets, and the mean drawdown was about 32 to 35%. So when that happened, we were able to take advantage of that. And so that's an asset, our growth bucket, as I had mentioned before. So we rapidly moved. Going into the pandemic, we were somewhat defensively positioned. Of course, we didn't anticipate the pandemic, but we had a feeling that assets were overvalued. And we do manage very mature pension plans, so we have to be somewhat cautious. So going into the pandemic, fully 1/4 to 30% of the portfolio was in short-term fixed income. And that really helped us. So when the market fell 35%, we moved very swiftly to up our growth allocation. And, I have very supportive boards who are very engaged and who fully back our investment decisions. And together with their help, we were able to increase our equity beta in the portfolio.
And in terms of asset classes going forward, what do you think where the biggest opportunity is? Is it in the distress space? I hear a lot about that, obviously, going forward. Is it more infrastructure, private credit in general? What are your thoughts on that?
All the things that you mentioned are very interesting spaces. In terms of a pension plan, the advantage that we have is we are long-term investors and we are patient capital, right? And to me, the way to manage a pension plan is to make your allocation and to hold steady and to not make too many changes. But from time to time, there are market disruptions that create opportunities. And we've had one such opportunity in March and April, which we took advantage of. Having said that, obviously, it's very easy to observe public market prices. And so what we saw was a drastic decline in equity prices, in public equity prices, and we could take advantage of that right away. Now, that's not to say that other asset classes were not impaired, except that it takes time to observe that, right? It'll be a while before those lower valuations are realized and shown. So Specifically in terms of the asset classes that you've brought up, private credit, we've had a very long economic expansion, right? And so what that's done is there's been an increase in non-bank lenders. There's been poor credit underwriting and some very weak balance sheets, unfortunately, right?
Right.
And so now with this impending credit cycle, there's going to be a divergence and there's going to be opportunities. I think the non-bank lending sector is here to stay. But I think, again, it all comes down to due diligence. I think it'll throw up a lot of opportunities. In terms of infrastructure, again, I think infrastructure is a very good asset class for diversification purposes. I feel that some of the really large LPs and pension plans can take advantage of it better than someone like San Jose, right? So if you have 100 billion in assets or 100 billion plus, then you can actually directly invest in some of these large projects. And I think the advantage of these infrastructure projects is the nature of their cash flows, which can match your liabilities for 30, 40, 50 years. The one thing you have to be cautious about, though, is a lot of these structures are very leveraged. And there's a lot of speculative capital in infrastructure, right? And now we're in a cycle where there's GDP decline. And with GDP decline and lower utilization of transportation infrastructure, it remains to be seen how some of these projects will do. And I think that's a third asset class. So we spoke about private credit, infrastructure, and distressed. I think you spoke about distressed. Now, distressed is another very interesting asset class or sub-asset class, as you will. And we are taking a close look at it. Of course, just because something is cheap doesn't mean it has good value. And so we continue to monitor those opportunities. So we are patient long-term investors. Our goal is our hurdle rate of 7% over the next 10 to 20 years. So we will wait and look patiently and do our due diligence as we look for these opportunities.
You had mentioned due diligence. I mean, how are you conducting due diligence on some of these GPs that are in the pipeline or that you're speaking to right now? Because you can't go out and do on-site visits. How does that play out in today's environment? Are there fewer GPs fundraising right now, in your opinion, or do you see a lot? Are you inundated with more calls and requests for meetings or Zoom calls?
Yeah, no, great question. So, in terms of fundraising is a constant, right? Regardless of the cycle, there's going to be fundraising. There's always companies looking for capital, even in this pandemic. They have to shore up their balance sheets. And likewise, GPs are looking for capital because they're seeing opportunities. Correct. In fact, just last week, I read in the Wall Street Journal that for the quarter ended June 30th, VC fundraising was almost as robust as it was a year ago. So we are seeing a lot of inbound inquiry in terms of fundraising. Okay. In terms of due diligence, our process has remained the same. It has not changed a whole lot. We've had to adapt to the new environment with technology, and so have our GPs. And so a lot of the work that we do is internal number crunching and analysis. The one area that's changed is face-to-face meetings. And we are having a lot of meetings, just like this one on Zoom. Right. One thing we've added to our checklist is in this post-COVID environment, as long as people work remotely, how is it going to affect our GPs and our GP team? Are they going to be as cohesive in this new environment? And that's something that we've added to our checklist. And fortunately for me at San Jose, I have a very, very talented investment team. They're all working very hard. And so our due diligence continues to be about the same.
So in terms of the global landscape, what are your thoughts on the US GDP and the global GDP? How are you viewing long-term growth in the world?
In terms of actionable items for us, what it means is, what is our allocation between US versus non-US versus emerging markets, right? We do have a large allocation to US markets, and we took advantage of that in the steep drawdown in March. And we do have some allocation to non-US developed markets as well. And emerging markets is another very interesting asset class. We have a lot of exposure to emerging markets. In fact, if you look at capital market assumptions over the next 10 to 20 years, and if you look at almost any firm's capital market assumptions in the public area, right, emerging markets are probably the only asset class where you can actually get 8 to 9% expected return. And for those of us in the pension arena, our hurdle rate is around 7%. So we need to be in asset classes that can actually provide us with that greater than 7% hurdle rate. And so we do have a large allocation to emerging markets. Unfortunately, emerging markets is a poor label, right? And it somehow implies that all these assets are homogenous and all these countries are homogenous. And that it's far from the truth, as you know,
Yeah.
with your involvement in an emerging market. So to us, Brazil is different from Russia, is different from China, it's different from India. Each of these markets have different pulls and pushes. And one thing to keep to make note of is, the US has a central bank, Europe has the ECB. Emerging markets don't have one central bank, right?
No.
So you have to look at the policy decisions of each of these countries. So I think it provides a lot of opportunity. I think in a post-COVID world, there's going to be greater divergence in the fortunes of some of these countries, which is where due diligence and hard work comes in. So we think there will be opportunities there. We are being cautious. And the other thing, Pranjul, is how do we get exposure to these asset classes? Obviously, in a market like US large cap, it's a very developed market. It's very hard to find alpha. And so we largely index our assets. Okay. We're very cost conscious, penny saved is a penny earned. Our boards are very cost conscious, so we take that very seriously. But in an area like emerging markets and US small cap, we think there's a lot of opportunity to add alpha. And in those areas, we do look for active managers.
Just to piggyback on what you just said, so when you're looking at emerging markets or small caps, so are you looking for a global manager, or are you looking more for a local player? What are your thoughts on that?
Great question. So we do have some global emerging market exposure currently in our portfolio, but going forward, the investment team is looking at country-specific opportunities, such as in China, India, and so on. And so we will continue to monitor these markets and make recommendations to our boards.
Now, when you look back at 2020, just in general, or maybe on a personal level, professional level, like what are 3 changes that you would hope to see, when you look back in, next year or the following year or 5 years from now? What needs to take place, or what do you hope that takes place here in 2020?
I think one thing is that, certainly I hope that there's more global cooperation, right? This crisis hit us from nowhere. None of us expected that. For the first time in the last 100 years, we've had one enemy. The whole world has had one enemy, which is the virus. And so there will be, looking back, I hope there's greater global cooperation and nations come together to deal with crises such as this. The other thing, of course, that I'd like to see is, we have a playbook now. Right. And people say that this coronavirus or some successor of this is going to appear frequently in the years and decades to come. And so I'm hoping that we'll have a standardized playbook. And next time something like this comes, we'll know how to deal with this. So I'm hoping for that. And thirdly, let me think. What's the other thing? I think technology. I think we've all learned how to use technology. And it looks like this remote work environment and what we're doing currently is here to stay for a while. Yeah. And I hope we embrace all these technologies to our benefit.
I totally agree. I'm not sure whether a lot of individuals are going to go back to work on a full-time basis, maybe come to the office 2 or 3 times a week and rotate. I think a lot of changes will take place. I'm not sure if a lot of global firms will need so much real estate, right, in all these parts of the world. So, maybe the real estate sector might take a hit, or there might be some opportunity in that respect. So absolutely. I agree with you. I think a lot of changes will take place after this pandemic is over, when we find a vaccine and all that. So just saying, on a more personal level, what have you been doing? How have you been keeping your time? Have you picked up any hobbies? I know you're in Northern California, but what have you been doing to keep busy aside from work?
Yeah, well, the last 16 weeks have been busier than ever, right?
Right.
It's as hard as I've ever worked so far in my career.
Okay.
So, it's unfortunately, I've not had too much time to either pursue my hobbies or pick up new ones. But the one thing I have done, it's beautiful weather here. It's a lovely place. Yeah. And I've been going on long walks, which is refreshing both mentally and physically.
No, well, thank you so much for your time again, Prabhu. We really appreciate it. I think our audience will find this, all your insights, very, very interesting, and we appreciate the time. Look forward to seeing you in person very soon, either in San Jose or at a conference. And until we see each other again, take care and be well.
Thank you, Pranjul. Stay safe. It's been my pleasure.